What's up, guys? I hope you're doing well. James here from jamesdforesight.com. So one of the things I wanted to talk about, and one thing that really clicked while reading this book called A Premiere on Money. I just found it on Amazon. It's written by from like the 1950s or 60s, I believe mid-1960s, by John William Wright Patman. He was a member, or I think chairman, of the subcommittee on domestic finance and of the House and Banking Committee, or Currency Committee, sorry. But essentially, one of the things with the bank run, because it's one of those, you always hear the typical argument with basically the cash problem, right? And so you have depositors and everyone coming in demanding all their cash, and then basically taking all the cash out of the bank, and there's not enough. Typical bank run, that typical story. One thing I learned from the Creature from Jekyll Island was something called the currency drain, to where it's kind of a similar process, but it has to do with the settlement between banks. And so instead of depositors coming in, it's whenever that bank tries or continues to settle in such a way that they're losing, or they're sending all of their reserves to other banks in the settlement process. And so that's another way that could happen. But one thing that came to mind, and what I was thinking about that this book specifically is kind of answered, is, how does this kind of, because we know like the financial and banking system is kind of pyramided in a way with debt and the whole reserve requirement, and so you have kind of a reserve multiplier, or whatever you want to call it. Basically, you put $10 in the bank and they can lend out 100. Your typical multiplier. So one, and just kind of, I've been connecting dots through some other stuff that I've studied too, like some of the previous videos I made on this channel. Like I think one specifically was like, what is cash visibility or something, to where it kind of, this ties into that as well. So basically, bank reserves are, let me start from scratch. So the Federal Reserve sends cash to their member banks. So say, let's just give an example of a commercial bank, say JP Morgan, whatever. And so if JP Morgan needs more cash, the Federal Reserve will send that to them in the form of physical cash, both physical cash and and bank reserves are liabilities of the Federal Reserve. So the Federal Reserve will send the cash to JP Morgan, a commercial bank, the one that requested it, and basically deduct that amount of cash from their reserves, right? Cool. Okay, so that's a decrease in reserves. Well, what happens when people come in demanding too much cash? And so you have that bank run kind of scenario, and they're running out of cash. So that means that if JP Morgan, for example, has to continuously withdraw cash and the Federal Reserve keeps sending it to them, they're reducing their amount of reserves, right? And so basically, from there, if you're demanding all your cash as the individual, right, you're taking away from the bank's reserves because they're giving it to you in cash. Well, those reserves are multiplied in their commercial bank liabilities, right? And so that's why it's important to really distinguish between whose liability is your quote-unquote money, right? So is it physical cash, where it's a liability of the Federal Reserve? Not really much of a problem in that respect. But if it's a commercial bank deposit, where it is a liability of the commercial bank itself, okay, now you come in asking them to transfer, or basically, I guess, maybe not transfer, but kind of change, convert. I think convert's a better term. You're asking them to convert their commercial bank liabilities that they promised you, right, into Federal Reserve liabilities. And the way they do that is by taking their Federal Reserve liabilities they own, bank reserves, so in the form of cash in this case, and converting that into their commercial bank liabilities, or, well, basically just fulfilling their liability with an asset they already known as bank reserves, right? So there's that. And basically, by doing that, you're reducing their amount of reserves. Therefore, that's reducing the base on which they can do their multiplier, right? So you have okay. Sorry, I've only had one coffee this morning, and I'm trying to do this before work. So you're reducing the amount of base, their kind of form of base money, and not like M naught, but like you're reducing that specific commercial bank's reserve base, and so therefore you're bringing down the total amount of money you can that they can multiply, right? And so, given the example of a 10% reserve requirement, it seems typical in most studies and such. Whenever that happens, so you withdraw $100, well, they lent $1,000 off of that, right? In this theoretical example. That means when you pull out your $100, they have to destroy, or they can no longer back $1,000 in their own commercial bank liabilities. And so kind of making that connection could be why bank runs are they're multidimensional, right? Because that's one of the things that I was always kind of contemplating is like, if they just don't have enough cash, okay, that's just kind of one. I mean, I understand why, but that's only like one dimension. And it was like, with how there's multiple dimensions to all of this stuff. So not only are they running out of physical cash, they have to basically take that from their reserves to fulfill their liabilities, literally. And then from there, and those liabilities themselves are multiplied by that reserve base. And so it runs out quickly, so to speak, because not only when you give them money are they multiplying it, when you're taking it out, they're having to divide it in a way. So anyways, it was just a major connection that I was making just from reading this book. And I'm going to go through and talk about this book more in depth in specific sections and stuff, because there's a lot to unpack. And he writes it from a very government-centric point of view. And so there's a lot more study that I'm going to have to do to go into the nuances of his point of view, just because it's kind of like I haven't heard of it that way before, and it makes sense, but it's also like I don't know if that's how it works. But a lot of it too still seems applicable to today, even though it was written in the 1960s, right? But yeah, anyways, I'll leave that one at this. So I hope you guys have a good night, and I'll see you on the next one.